Okay, good evening, everybody. Hope you're all doing well. Thank you so much for joining us tonight. My name is Gideon Pfeffer. I'm the CEO and managing partner of the GSH Group, and I'm joined tonight by Amy Young, our head of asset management, Alex Goldfarb, our CFO, and Mark Benyas, who wears many hats at GSH, but I like to call him my consigliere. Tonight, we're going to talk a little bit about GSH, the market, our portfolio, and have some time for questions and answers for you all joining us. Obviously, we try at GSH to communicate a lot to our investors, as you know, because you get all the emails. We send out at least one property update per property individually every month. We do our quarterly reports. And then we try to keep everyone informed on things that are going on in the company, things that are going on in the market from time to time as well. So I think that some of the things that I'm going to talk about tonight will be a bit redundant to what we've written in our reports, but I wanted to give everybody an opportunity to see me, to hear me, to be able to ask me questions. I found that I've spoken to a handful or two of investors after the last couple of quarterly reports that have come out over the last, 3, 4, 5 months. Sometimes investors just want to hear the information from me and ask me a couple of questions, discuss the reality of the market and how that's affected some of our investments and some of our business plans. And I believe that after those conversations are had, myself and the individual leave the phone call feeling more informed and better. And so in doing a couple conversations over the last few weeks, I decided that maybe not everybody wants to reach out to me. Maybe not everybody thinks they can. And so I wanted to make myself available to everyone because we're in a new phase of the real estate market, new phase of the market economy in general. And I know that everybody is focused on what's going on in the general market, in the equities market, and S&P. What's the Fed doing? Are they going to keep raising rates? How does that affect our retirement? How does this affect our real estate portfolio, et cetera, et cetera? So I can speak to real estate specifically and your investments you have with GSH, and that's what we're hoping to do tonight. So I'm going to do my best to keep this webinar to 60 minutes, 75 minutes tops, just in the interest of time. So I'm gonna go through information. I'm gonna do it quickly, and if you have any questions, you should be able to hit your Q&A button at the bottom of your screen and type in a question. You can type that in now. You can wait towards the end, but towards the second half of the presentation, we'll give some time to read off some of those questions and to answer those to the best of our ability. So that's kind of the flow of how things are going. So I'm gonna share my screen and just share a little bit of a refresher about the GSH Group. And sometimes when I do this, my screen freezes like it's doing it. Oh, there we go. So as you know, the GSH Group comes with a lot of experience. Myself and my partners in our executive team has well over 40 years of experience in real estate and residential real estate. Here's a great picture of our team taken this July during some of our 5-year anniversary festivities. And I wanted to kind of start off by reminding or sharing with you what the mission of the GSH Group is and what we focus on as a team to the best of our ability on a day-to-day basis. And we look at our clients as twofold on two hands, right? On one hand, we have our residents, and we strive every day to provide our residents with a safe, clean, and affordably priced place that they can call their home. And on the other hand, we've got our investor partners, and we strive every day to provide them with a safe and transparent way to achieve a superior return. And so it's with that mission in mind on both fronts that we operate on a day-to-day basis in the weeds and granularly to support that mission. We've been very fortunate over the last 5-6 years now to build a wonderful portfolio. Our portfolio is valued upwards of $1 billion. We've gone through 14 full cycle deals. Some of these numbers include properties that my partners and I owned prior to GSH. We've been involved in 39 apartment communities, acquired over 9,000 apartment units. Our average cash on cash return to our investors has been 10%, above 10%, and our tracked IRR returns to our investors, on a deal basis, are 24% plus, and that includes not only deals, full cycle deals that we purchased and sold, but also based on a valuation of the portfolio. If we were to, exit our portfolio now, that's where those numbers come up from. As you can see by the shaded in blue, our executive team and partnerships have transacted all over the country, in multiple states, and just have a rich history and experience in real estate transaction that provides significant depth and experience that we bring every day to GSH and this venture and our portfolio. To date, since 2017, we've been fortunate enough through investors like yourself to raise up approximately $300 million. We haven't taken on institutional equity. Institutional equity to me means like large family offices or hedge funds, private equity groups. We've done it all with individual accredited investors like yourself. So thank you very much. It's because of you we've been able to grow and perform the way we have. As I mentioned, depth. We look at ourselves holistically, and we've got an experienced staff and a strong management team. We're a preferred borrower with our lenders. It allows us to pick up properties off market, to find opportunities that not every buyer has, and we're able to perform at the level that we have at this point because we're in our properties, at our properties every day. Now, while we don't self-manage the properties, as most of you know, we use best-in-class third-party property managers, and we have a affiliated construction company that has similar ownership that we control, and that allows us to be vertically integrated on our business plans on a day-to-day basis, along with our asset management team. Something that we've been focusing on over the last 24 months, really just before COVID happened, and throughout, and I think that's really going to propel us into the future and differentiate GSH from competitors, is focusing on the resident experience. Rental growth has been exceptional, and it's benefited all of us. We're seeing that flatten a bit. I think that we're reaching a ceiling at this point in certain markets and certain properties, and there's been a lot of investment in the apartment market, like you all know, and so a lot of properties have been purchased and renovated and enhanced, and renters have a choice of where to live. So it's up to us to provide the best resident experience. We're doing that on a few different levels that we've shared that are on the screen. Happy to chat with you more about that offline. And later on, when we talk about management, maybe we'll touch on that a bit at that time. We also are really committed to ESG investing, which is a term that's become more and more popular over the last 24 to 36 months. But it's encompassing not just profitability in an investment, but social impact. From the very beginning, GSH has been committed to providing an affordably priced place for our residents to live, and we focused on workforce housing. For America's workforce, which turned into essential workers during COVID, and that's who we've been targeting all along, right? We've always been focused on the teachers, the service workers, the firefighters, the policemen. White collar and blue collar, providing affordably priced places to live, not at the top of the market, not on the lower end of the market, right in the sweet spot, right in that kind of B class location. where there's a disproportionate amount of need for that type of affordably priced places to live, and there's a shortage of housing units. So from the very beginning, our strategy was to focus on that section, those type of existing assets that we could buy at or below replacement cost and enhance, because there's a finite amount of those units, because you can't build a B-class asset anymore. You can't build an affordable place to live. When you build, you have to be at the top of the market. So find the existing well-positioned asset and enhance it within the community, provides a ton of benefits, and that's been our business model all along. These are the G, the S, and the H. Some of you know all three of us, some of you don't. But I thought it was important that I share who GSH is, and obviously our dedicated team that you've probably had interaction with quite a few. Okay, so I'm now going to share another screen with you, which is a quick economic overview. And I'm going to do this also with a caveat saying that I'm not an economist, and I didn't put together this presentation. Okay, well, kind of did, but I was at a conference in Florida 3 weeks ago, and it was a great event where I absorbed a lot of information, where I was able to meet with our key lenders, and talk about the market, talk about our portfolio, talk about our loans, plan together and strategize on some of our floating rate bridge, and participate and see them speak, industry leaders and folks at a bit of the top of the food chain, to share with us about the market. And this was a presentation that one of my lenders did, the owner of the company, and I asked if I could have a copy of it, and they granted it to me, but I stripped it down from their branding so I can keep that anonymous. But it was intriguing to me, and I thought that I'd share it briefly with you. And I do that again by saying that I'm not an economist, but we can all draw our own conclusions on here. But what these slides are going to do are basically going to show where we were, and where we are, and the change. And the biggest takeaway that I had from this specific presentation and some of the other presentations was that, the last 10 years was really unprecedented. It was the longest recovery in U.S. history, and what I've learned is that it was one of the reasons why it was the longest recovery was because it was one of the biggest dips. The global financial crisis. So when you have such a back step in economic conditions, it takes longer to recover, but that was a benefit to us because prices dropped in equities and real estate, and those of us who were able to purchase and ride the wave benefited not only from an upward tick in real estate prices and rents, but also low interest rates. And so where were we, right? Rent growth had grown for 10 consecutive years. We've had historical lows in vacancy rates. Investment volume has been in historical highs. I shared a letter to you via email earlier in the year talking about the competitive nature of multifamily, and why our prices were continuing to go high, and our returns were looking diminished on new deals that we were looking at, just because of the amount of investment volume coming into the space, and why. Cap rates at historical lows. For those of you who don't know what a cap rate is, it's how we measure the value of a property. So when cap rates are low, that means that values are high. As cap rates come up, values come down. Now that we're seeing interest rates go up, we're seeing cap rates follow and come up, because the more expensive it is to borrow, the less attractive a deal might be. The more returns get diminished. So cap rates have to come up and follow those interest rates. Like I said, it was the longest expansion in U.S. history. It was historical unemployment, low interest, low inflation, multifamily construction increasing. And then what happened around pre-COVID, what we saw was the Fed actually started to taper rates up. They actually started in a slower pace to bring rates up. And then when COVID happened in early 2020, they brought rates back down immediately, and they kept them very low. And what did we get? We ended up having inflation. Here's a chart showing cap rate trends as it relates to the 10-year Treasury, and 10-year Treasury is the index that we borrow off of with our long-term fixed rate interest rates on multifamily. So as you can see, between 2020 and 2022, interest rates for multifamily have been going up, but cap rates have still been going down. Now, a caveat to this is that this was prepared in early November. Since this was prepared, the Fed has increased interest rates even more by 75 basis points a couple weeks ago in November. It did sound like we got some potential good news today, but we'll see what that looks like with the announcement that the Fed may slow their pace or the amount that they're raising rates. But I have my own opinion on how long that'll go, and I think we've got at least another year of rates increasing, just maybe not as aggressively as we have. As you can see here, this is during COVID, right? COVID is considered a recession, but it was the shortest recession in history, about 2 months. But 22 million jobs were lost, and the unemployment rate went up to almost 15%. And to protect the economy, and as we all know, there was an enormous amount of government stimulus that was passed out. Because of that, consumer debt decreased, household savings increased, and there's a lot of pent-up demand for spending. So what were the effects? Flight to the suburbs and remote work, which we all benefited from as multifamily investors. Historically high rent growth, because investors or individuals had more money to spend on choosing where they wanted to live, and unprecedented home price growth with low interest rates for housing. We also experienced low housing supplies and high demand, supply chain interruptions, low population growth and migration, a ton of retail sale expansion, and inflation. So where are we now? As you can see here, we've got a low unemployment rate, and consumer prices are high. And what we've got here is kind of a trend here. As you can see, the gray pillars that are vertical are U.S. recessions. As you can see, during U.S. recessions, unemployment goes up, and then during expansions, unemployment goes down naturally. Unemployment, as you can see all the way to the right, went up during the pandemic. It's now come down. I expect unemployment to start coming up, and we actually need unemployment to go up for that recession to happen, to control pricing, to control inflation. And so I think that's what we're going to see. That's what the Fed is trying to accomplish, amongst other things. I mentioned earlier that this was the longest recovery. The yellow line represents the amount of months that it took for us to recover and return to the employment levels from pre-Great Recession, from the aughts, from December of 2007. It took 78 months to get there, which was a very long recovery and a great time for us all to be investors. This is just a graph showing the amount of multifamily structures created and investment spent on multifamily. As you can see, over the last 10 years, it's gotten larger and larger and larger. And what's interesting to me about this chart is that, as you can see, over the previous decades, the last 5 years, 6 years, 7 years, the numbers have started to almost double what the average was for multifamily investment And that's why we saw pricing go so high. And it was a product of extremely low interest rates, and more institutional type investment coming into the space. Because really before the global financial crisis, the majority of multifamily investment were more like what they call smaller investment groups like us, or mom and pop investors, people that built and owned long-term, families that owned long-term. I'm going to fast forward through multifamily housing starts. This is an important one that I wanted to get in. I can share this with anybody who wants to shoot me an email. In the interest of time, I'm just flipping through some of these things. What you can see here is the personal savings rate versus the personal spending rate. Spending continues to go up, right? And there was a lot of stimulus that created some of these spikes. But the savings rate is now on the decline. So you can see here around around 2000, around COVID, COVID was like March, April, May, is when this personal savings rate spiked, because we were all indoors, right? We weren't going out. The world was going to end. And then we started spending some of our money, and then it peaked up again, probably with stimulus checks. And now we've been spending our money, and our savings rates are going down. So the great resignation and folks who are out of work by choice, I think that trend may be coming to an end. As you can see here, delinquencies are starting to go up again on credit cards, and consumer credit is going up. So we're in an interesting time, and these trends are, what I'm learning are trends that you see when recession is coming. All right, so I'm stopping sharing now. I get to see my face again. And so what I'm going to do now is I'm going to talk about just a quick portfolio update or overview of GSH. And I'm going to talk about what's going on now, what's different today than what was going on maybe a year ago in the market. I'm going to talk about some of the challenges that we're facing in some of the properties in our portfolio, and what we're doing to curb those. And then I'm going to open it up for questions and answers. So GSH, like the slide said before, including some properties that we purchased before GSH was officially an entity, we've purchased an aggregate 9,000 units, but GSH proper since 2017 with investors like you, we purchased just over 7,400 units. We've sold about 1,800 units. So our portfolio sits just below 6,000 units today. 70% of our portfolio is stabilized. We performed our value add plan. It sits with long-term fixed rate mortgages, and is producing at least our preferred return on a quarterly basis to our investors, as a lot of you know. The other 30% we purchased would represent properties we purchased in the second half of 2021, the first half of 2022, and we purchased those on floating rate bridge loans. Why did we purchase properties with floating rate bridge loans, right? Why didn't we just lock in with fixed rate debt? As I've spoke about earlier in the webinar and in my emails, pricing was such in the multifamily market that in order to achieve a desired investment return, we had to focus on value add properties being properties that exist, that we buy, that we felt we could grow the income by improving the interior of the units and charging more rent, being more efficient with management, basically increasing revenues and decreasing expenses, or a combination of both, right? So finding properties that were heavy value add that required a decent amount of construction, it was advantageous to take out bridge debt in order to limit the amount of equity that we needed to raise and generate the type of returns that we all desire. Bridge debt was desirable because it was like a construction loan. We could use it to buy the property, and then we could do construction and draw down construction funds in order to do that. Those bridge loans have floating rate debt. How did we mitigate the risk of interest rates going up? Right. Well, what we did was we bought rate caps. Excuse me. We bought rate caps on most of our bridge debt, and what that does is that caps the amount of it caps the level that interest rates can go up to for a period of time, typically 2 to 3 years. We also underwrote, to industry standards, interest rates going up, our mortgage payments being higher than what, throughout the course of the bridge than where we started, and probably equally as important, the interest rate that we would eventually refinance out of our bridge into long-term debt, we would set at anywhere from 100 to 150 basis points higher than the existing debt rates at that time. 100 basis points equals 1%, 150 basis points equals 1.5%. So if the interest rates in October of 2021 for a 10-year fixed rate mortgage was 3.5%, we would underwrite at 4.5 or 5%, and that's what we did for our takeout loan. What's happened is that interest rates have gone up much quicker than anybody anticipated, and we didn't guess, right? We didn't say, well, we think we think it should be 1% or 1.5% higher. This is what lenders do. In fact, lenders typically do 1%. Sometimes we would do 1.5% to be even more conservative. There were forward curves. There were algorithms that the market would use based on an expectation of where the LIBOR index rates or the SOFR index rates where that bridge loans are tied to would go in the future, and we would underwrite based on those curves. And so we felt at the time with the rate caps and following industry best practices for underwriting that we were in good shape. And what nobody knew was that interest rates in these indexes would spike in 2022. And so the stressors that we're feeling in terms of higher interest rates, so higher mortgage payments, is and higher interest rates for takeout loans. It's not a GSH only problem. This is an industry-wide problem. And I've been to 2 conferences just in the last 3 months. And that's all everyone is talking about is interest rates, is floating rate debt, and it's how are we mitigating the issues that we're experiencing because of the sudden rise in interest rates, and what are we doing to be able to refinance out of them. Okay, so what are our biggest challenges right now? Our biggest challenges, I'd say, portfolio-wide, is that, because of inflation, we're seeing higher expenses, right? We're seeing higher expenses on fixed costs, right? Property taxes have gone up because property values have gone up, both in single family and multifamily. Insurance costs, the insurance industry is completely in flux. And so insurance costs are literally 50 to 100% higher than they were just 24 months ago. Utilities are higher, heat is higher, water is higher, staffing and payroll is higher, material and labor expenses is higher. So across the board, we're feeling the effects of inflation. While we're benefiting from the rising rents, we're also feeling the pressure or the squeeze from an expense perspective. As you all know and have heard on most of our reports, evictions have been a real issue. There was eviction moratoriums that came into play, rightly so, when the COVID-19 pandemic happened. You know, people weren't working, people couldn't leave their homes, and their homes needed to be protected. We worked with all of our residents. We didn't take much government subsidy. We didn't do any forbearance on our loans. We didn't have to, even though those options were there available to us. But what we've experienced is that there's been a lag in certain municipalities and counties throughout the country where we're still dealing with slow evictions. We own 2 properties in Prince George's County in Maryland, and those evictions literally are 8 to 10 months behind. So we're getting evictions happening at this point, but on cases that we submitted earlier this year. Our value add plans on most of the properties that we purchased in 2021 and 22 included removing residents who are not paying, and bringing in a higher quality resident at a higher rental rate. When we can't evict those residents, or we can evict them at a slower pace, that slows our value add plan, that slows our ability to increase revenue at the pace that we expected, and hurts our cash flow. I would say that so cash flow has been a concern, and as some of you have seen, depending on what investments you're in, we've tapered down some of our quarterly distributions. You know, in our marketing presentations, when we're raising money in our syndications, we have kind of an expected type of yield that we're trying to target on a annual basis, right? That we pay quarterly. And up until this year, we've always hit those numbers. But because cash is tighter, we want to protect the integrity of the investment. We're needing to be more cash conscious and hold back on distributions. And even on 2 of our properties this past quarter, we didn't make distributions for those reasons. And the other big thing that we're focused on is with our bridge loans is getting out of that bridge debt and getting out of it sooner than later, because rates have gone up so high. As I mentioned earlier, you know, we pro forma, we forecasted interest rates being higher when we did our initial modeling of these deals, and we put those interest rates up higher, you know, 1% or 1.5%. But what we're experiencing today is that interest rates are like 2 to 2.5% higher at the moment than where they were when we purchased the property. And when interest rates are higher, the amount of money that you can borrow is reduced. So if a business plan was, we have a $20 million mortgage, and a bridge mortgage, and we're going to increase revenues, and we're going to refinance it, and we're going to get a $25 million loan at 4.5%. You know, and we're going to pay off the original $20 million loan, and we're going to have $5 million to maybe give back to our investors at that time. If an interest rate now is not 4%, it's 5.5% or 6%, we might only be able to get $20 million. We might only be able to pay off the debt, right, and not return any equity to our investors. We might only be able to borrow $18 million, right? And in that case, there'd be a gap to where we need to be. And I think that's probably one of our biggest focuses today is reforecasting our performance for the properties that are on bridge, and determining how high can we raise our NOI, how profitable can we create and make these properties in this 2023 calendar year, so we can refinance out. And can we refinance out and at a minimum just pay off the bridge loan, right? And will there be any gaps? Like I mentioned, will we fall short in terms of where we need to be when we refinance? And I mentioned I was in Florida. I was meeting with our lenders. The good news is that GSH is a preferred borrower with our lenders because of the volume, because of the depth of our organization, because of how we present ourselves and how our portfolio performs, our lenders have come to us and said, in most cases, we're going to have gap financing for you in the form of like a mezzanine loan, which would be like a second mortgage almost. So when it's time to refinance out, if there are any gaps, we should be able to take on a mezz piece that will bridge that gap. So no type of investor capital call is required to fill a gap. What does that mean for us as investors? Remember, myself and my partners have invested our dollars right alongside yours, right? So we're in this together, and GSH doesn't make a success fee until you earn your preferred return and you get all of your capital back. So we're incentivized, and our interests are aligned not only as investors together, but also as a business to make these properties profitable. But what would happen is if there is a shortfall, or if we aren't able to return any equity on our refinances, our business plans are delayed. Our business plans are extended. It'll take longer for us to increase the revenues to start paying those higher returns. Most of our deals have a 9 or 10% preferred return. And if you remember, preferred return it's not a guaranteed return, but what it means is that our investors get that return every year before any success fee is earned by GSH. So it's the preferred when we do a refinance or a sale, everyone is made whole on their preferred return, then your equity is paid back, and then there's a profit split after that. So if you're not earning that 9% return every year right now, if I'm only sending you a 5% return on some of these bridge loans, or a 2% return on some of these bridge loans, the difference between that 5% and that 9% is accruing for you. And we have to pay it back to you before any real profit is generated. So your investment is safe in that perspective. And I thought it was important for me to remind you of that. So those are our biggest challenges right now. And I want to get to what are we doing to mitigate the challenges. And I just sent out an email the other week talking about that. That was because of some direct feedback from our investors. Gideon, you and GSH are doing a great job communicating what's going on with the properties and some of the challenges you're facing. Can you share a little bit more about what you're doing to mitigate it? So we wanted to put that out to you. And so I wanted to talk about the creation of our asset management team, to talk about the transition from BESTEC to RPM living from a property management perspective, and what we've been doing to try and accelerate evictions and things like that. I wanted to introduce Amy Young. Amy is the director of our asset management department. She comes with decades of experience on the property management side, and has completely transformed our asset management division. And Amy, maybe you could take a couple minutes just to talk about yourself, your experience, and the team that you're building, and what you're doing, what we're doing as a team, to focus on the portfolio and the performance of the portfolio.
Sure. Thanks, Gideon. First and foremost, I'd like to talk about the team that we're building, because I just think they're all superstars. We have several members of the team who've been with GSH for many years, and they specialize in our lender compliance, our insurance analysis, and also special projects. They're boots on the ground, and really are the backbone of what we do in asset management. I also have a great partner in Lisa Smith. She's our director of asset management also, who shares the portfolio responsibilities with me. She has over 25 years experience in property management. And between the two of us, we really have a high touch approach on our assets. We do deep dive reviews on really literally everything that crosses our desk, whether it be financial statements, even down to general ledger reviews, so that we can look for opportunities to create savings for the properties, as well as generate ancillary revenue. And we're present at the sites regularly. So we are out on the properties with our management agent partners to inspect what we expect. So I think that's another competitive advantage that we have for our asset management team. And we're also adding a third asset manager who starts next week, who also brings over 25 years of property management experience to the table. And I think that background lends us to knowing what questions to ask for our management partners that we've had to date, and also helped us identify who our next management agent partner should be in RPM Living, because we knew what we were looking for to bring improvement to the properties.
Awesome. Thank you, Amy. I appreciate that so much. I wanted to also give Alex Goldfarb an opportunity to share a little bit about what we're doing to reevaluate all the costs associated with our value add plans, and kind of reforecasting our properties based on the new reality of expenses and such, and charting a path towards those property refinances and sales. And Alex, I couldn't help myself but like peek at the questions that were being asked, and there's a couple, if you saw, that have to do with the reforecasting and such. So if you haven't had a chance to say those, I'll ask them of you after you go through what you had prepared.
Thanks, Gideon. So not to be redundant for the email that we sent out previously, but just focusing on CapEx before we go into the reforecast. There's 3 buckets of CapEx that we focus on each property as part of our initial business plan. 1 is property preservation, 2 is CapEx that's going to increase revenues, and 3 is, miscellaneous and various CapEx items that probably won't increase revenues. So what we have done over the past few months, and we're spending every waking hour working on this for, our general properties, but in particular our bridge loan properties, is we're reevaluating our CapEx plans on a really daily and weekly basis and seeing, okay, are the budgeted, amounts and various CapEx projects that we put in each bucket still necessary at that point to achieve the rental premiums and or return on investment that, we need in order to increase NOI and get closer to a refinance. So in order to do that, we're working very closely with our asset management team. We've brought on additional financial analysts and staff to help aid that process. We're working extremely close with our construction team and, continue to work close with BezTech, who is our previous property manager, and look forward to continuing to work with RPM, who's, coming in as our new property manager. Then secondarily, to add on to that, on the reforecast side, which Gideon kind of touched on, again, over the last few months, and something that we do every day, we reevaluated every single dollar that's been spent on each of these bridge loan properties. We've looked at how it's been spent compared to pro forma. We've looked at return on investment. We've looked at, where there's been shortfalls, where there's, been surpluses. And, we are continuing to reevaluate, our budgets and our expected cash flow really on a monthly basis, in comparison to our monthly financials, but actually looking at cash flow on a daily basis to see where are we going to sit over the next 12 months, where we're going to be over the next 18 months, where are certain items that we can hone in to, optimize our cash flow, where are certain shortfalls that, we might need to have some relief, such as bringing in, kind of as Gideon said, mezz financing or pref equity if our refinance targets end up falling short. And with that, we've been teaming up with our lenders and, a very, good advisor of ours, Meridian Capital, who's been a great, advisor and mortgage broker for us to go through, all of our deals in the bridge debt on a monthly basis and have them help us come up with target NOIs, figure out, alternative lending strategies, potentially not looking maybe at Fannie or Freddie, because the cost of that capital, the cost of that financing might be a little higher, but even looking at HUD financing, which has a lower debt service coverage ratio, which I don't need to go into the definition of that, but it allows us to take our current NOI and get higher proceeds than maybe, standard Fannie or Freddie would. We've also, explored various other options of alternative financing, PACE financing, alternative equity. So we are spending, every single day, our entire team, it is our, primary focus to be on top of and be proactive in figuring out what we need to do to get out of our bridge debt and to, continue to push our business plan forward and be successful, for the next year and, many years after that.
Awesome, Alex. Thank you. You touched on something that I want to add to, which is, and one of the questions here from Warren is, are we going to be reforecasting these deals and resetting expectations for investors? And so the short answer, Warren, is yes. The reason why we haven't put that out yet is partly because of the transition of property management. We're going to be working with a new property manager to define an aggressive but realistic budget for 2023. And they're just taking over right now. This is the time of the year when budgets come out anyway. So we're not like too far behind really at all as it relates to creating realistic budgets for 2023. So I imagine that early to mid first quarter, we're going to be able to have our budgets final. Now, we're working on these new budgets in concert, not only with the GSH team and the teams that Alex and Amy lead, but with the property managers who are going to be on the ground executing that business plan. And we're also working in alignment with our lenders, like Alex said. So all of us are working together to set expectations of what is the bogey that we need to hit to achieve our goal of a refinance, and how do we work backwards from there within a budget to achieve that goal, right? And so that's what we're working on internally right now, every day, and while also focusing on our properties that aren't in the bridge situation to make sure that we're maximizing the profitability of those properties. So it's a heavy lift, and we're up to the challenge. But I wanted to kind of tell you what our strategy and what our plan is. So there are some good questions up, and I'm gonna touch on them now. And if you haven't had an opportunity to type in a question, again, you can, if you move your cursor on the screen, you'll see a little button at the bottom that says Q&A. And if you click on that, you should be able to type in a question if you have one. That's what really, besides me talking at you for 40 minutes, the Q&A is really what I wanted to have available for you if you had any specific questions. And obviously, if you don't feel comfortable asking the question in this forum, send me an email. Let's set up a call. I'm always available, or any of us are. Somebody asked if we bring pref, equity, or mezz into a deal, if we have a shortfall, to what extent will that dilute existing investors' ownership percentage in the property? And I think that's a really important question, and one that I'm sure is on a lot of our minds. And first of all, our goal is to not be in a position where we dilute investors' capital, right? That obviously, I think that goes without saying, but I still want to say it. And in a mezz situation, equity wouldn't be diluted because that's more of a mortgage instrument. Okay. And pref equity position, that could dilute because that's an equity position. And at the moment, like I'm not sure if that is going to be necessary. Okay, I can't sit here and give any guarantee. I don't have a crystal ball of what our portfolio is going to look like or what the overall economy is going to do to us over the course of the next 10 months. But as based on information that I have today, based on conversations with the lenders, and based on our initial reforecast of the properties, we should be able to either refinance out of our debt on some of our properties or get into a mezz situation on our properties. And again, we've always been long-term minded. We believe in the real estate that we purchase. We believe in the location. We believe in the business plan. The unfortunate thing is that the economic forces that are at hand that we're dealing with is just extending this business plan, so the profitability is not going to come as quickly as we had hoped. Somebody asked, what about using swaps? And I'm not exactly sure if I understand the question. What I can tell you is that swaps are an instrument used in rate caps. So that's where my head is going. Alex, you correct me if you think I'm, yeah. So We do have rate caps on majority of our bridge debt, as we mentioned. And what we're trying to do is to get out of the bridge before those rate caps expire. So as we've shared with you in your quarterly reports, I'd ask you to refer to your quarterly reports for your properties from this past quarter. Most of the deals that have bridge talk about the rate caps, what the rate caps are, when they expire. If you have any specific questions, you can follow up with me or ask me in the chat. I'm happy to talk on a property by property basis. All right. So there's a question about what are we doing to reduce expenses, conserve cash? We understand that improvements are important for getting increased rents. But that being said, is there room for prioritizing conserving cash, especially at properties where there's a risk of gap? Great question, and something that we're talking about every day. Alex touched on it, but I'm going to jump back into it. And he was talking about 3 categories at a property for CapEx, and sometimes I forget that, like, we do multifamily every day, and you don't always do, and you don't, right? So a refresher for CapEx means capital expenditures, and for our purposes, it means the renovation planned for a property. So if we purchased a property and we planned on elevating the interior of the units, that would be the CapEx work in the units. Or if we were planning on redoing a roof or the clubhouse, that would be CapEx works. And so to answer that question about conserving cost, we've analyzed all of our properties that still have CapEx work to do to fulfill our business plan, and we've identified 3 buckets. One is property preservation. So we plan to own these properties for a long time, or there's just work that needs to be done, right? Just to make it a safe, clean place for people to live, right? So those are things that we have to spend money. Then there's dollars spent that will have a direct return on investment, where we'll be able to justify an increase and allocate, basically align. We're going to get this amount of an increase for doing this amount of work. That is money that we want to spend. And then there's work that is harder to quantify, that we're going to actually get a return from, and that's money that we probably won't spend. At the same time, I want to be clear that, even though I'm saying we're long-term minded, it's going to take longer to make our returns if we refinance and get mezz, whatever. We're also evaluating if it makes sense to sell, right? If there's a property that could have a gap, or there's a property that we have an opportunity to exit and earn a modest return, we're keeping all options open. And again, we're working as a fiduciary, as a steward of your invested dollars and our own invested dollars, and capital preservation is our number 1 priority. And then profitability is our 2. And so we're evaluating every potentiality. One question that has come up is we talk about holding properties longer. And would we imagine that a hold period could extend beyond 7 years? Specifically was the question. And that's a hard question for me to answer at the moment, right? Because we're still working through what our reforecasts look like. I think that for GSH, a win on any deal would be to own it long-term, to use strategic financing, and to give everybody their equity back, and to own these properties into perpetuity, right? And having said that, we've exited properties, and there's folks on this call that have benefited from that. And we kind of let the market determine when it's the right time to sell. I can tell you that if we can't sell for a profit within the next 7 years, then we won't sell, right? And that's probably the best I can do to answer this question at the moment. There's a question about why are we switching property management companies, and I'm going to keep that one simple. The answer to that question is we feel that based on the size and scope and location of our portfolio, we're looking for a property management partner with elevated resources and the ability to elevate not only our properties but our operation. We are super grateful for the relationship that we've had with our property manager that we're moving on from. We really stood on their shoulders early on in the relationship as we were a small company and benefited from their experience, and they've been a great partner. And at times it just becomes time to move on. And that's where we are today, and so we're super grateful for the property managers we've used up to this point, and we're super excited to be working with some best-in-class nationwide type organizations who we really feel like will elevate our properties to the next level. Somebody suggested tax appeals and utility incentive programs. We're on it. We're also on additional revenue sources. We're looking into, there's a lot of options for multifamily apartments, right? There's cable revenue, there's insurance revenues, there's the potential for cell phone towers. We have that on one of our properties. There's the potential for billboards because some of our properties are adjacent to highways. There's cable revenue sharing programs, and there's many others. And we've got on Amy's team, we've got a couple team members dedicated specifically to those incentives, working with our property manager to increase. Every year we work with a tax appeal attorney. Every year they evaluate where our taxes are and give us suggestions or recommendations if we should be appealing or not. It's a great question. What's my prediction for new deals in 2023, both existing properties and development deals? Okay. And I had another one saying, what about new development? And what about the funds that I've mentioned? All right. So I did mention on the email that I sent out to you, PTOs. My wife, Jamie, I don't know if she coined that phrase or not, but she's the one that taught me PTO, problem to opportunity, right? So we are continuing. We've got an acquisitions department that continues to underwrite deals. It's been a little tricky to decide if, we've been cautious. All right, let me say that. We've been cautious about new opportunities. We wanted to focus on the properties that we have. That's our most important focus. But we also want to keep our mind open and bandwidth open for opportunities, because when there's economic uncertainty, there could be opportunity. When others are fearful, be greedy. When others are greedy, be fearful, right? That old adage. So we're doing very well on our new development project out in Holt, where we're building 100 units with a best-in-class JV partner, and we've been looking into working with him to do a whole redevelopment play of an area in Lansing near Holt. So I think that there's going to be an opportunity to get involved on that front to start. There's 3 existing assets, and there's about 4 or 5 sites adjacent in one corridor where we're starting to negotiate with landowners to take down that land and phase out the redevelopment of the entire area. We'll probably take over his existing 3 buildings in some sort of a joint venture. This is our partner on our Esker Square development that we've developed a great relationship with. So that's forthcoming for sure. Well, I shouldn't say for sure, but most likely. The funds that I mentioned, we've got an opportunity fund that's going to be available for opportunities that we see in the market. That fund will be more location agnostic, just looking for deals with good real estate fundamentals and a good story in terms of upside or discount to market. And then we're doing our growth fund, which is going to be focused on areas of growth where demographic shifts and where the numbers don't lie, that population is growing, population is shifting, people and jobs are moving in certain areas. we should get in on that focus because those trends present a great opportunity. Those are coming. We got a little bit delayed because of what was going on within the market and focusing on our current portfolio, but those are going to launch in January. We'll continue to offer deals deal by deal. The funds will allow you to participate in multiple opportunities. And I look forward to having conversations with you all about, should you keep doing it the way you're doing it? Should you jump into the fund? We're also starting to see, because of our connections with lenders, with owners, with developers, we're beginning to see opportunities for discounted purchases. So we're evaluating actually right now the opportunity to purchase a brand new construction, a project just delivered in a highly coveted market in Michigan at a very big discount to market, at a price that wouldn't have been imaginable a year ago. Very excited about that. We don't have it 100% secured yet, but you will all be the first to know when that comes in play. And look, we're tempered. We have situations with our bridge loans that we're paying a lot of attention to, as you know. And so we want to get into deals that make sense. We want to, unless we're doing new development, we want to stick with fixed rate debt, and we want to look at deals that make sense from a purchase perspective, from a value perspective. And it takes time. What we've seen is that as interest rates came up, cap rates are always kind of behind in timing. So what that means is that sellers just weren't willing to sell for what the new market demands on pricing have been, and now we're starting to see a little bit of those expectations even out. And at the same time, there are groups that are not preferred borrowers with their lenders who are less capitalized or not as well capitalized as we are, less sophisticated, that are going to need to sell at a discount because they're not going to be able to bridge that gap that we talked about, and we want to be available, and we want to take advantage of opportunities as they come, and we're hoping that you'll come along with us on those opportunities. I'm going to read another email. Does it make sense to sell the underperforming assets even at break even in order to compile a significant cash cushion to use those funds to pick up fire sale deals over the next 12 to 18 months? I think that the theory, this is just my opinion, right? What I'm saying isn't law, but what I would say is that the strategy is sound, and because we're in these deals with so many investors, we have to do what we think is best for the majority of the investors. And so if we feel like exiting a property for a par, like at an even keel with no rate of return, just to get our capital back, we would do that because we fear that there isn't upside, or it's going to be a challenge to get that upside. And we would make that decision, right? And I think that that's us being a steward of your money. We probably wouldn't exit a property that we felt could be profitable in the future, under the hope that we might find a better deal. If that makes sense. All right. Are we going to hear any wisdom from Mark, or just getting to see his pretty face? Mark had a pretty solid cold, but he told me he'd join. I wanted to add, Mark comes with decades of real estate experience. He's been in 38 different markets and transacted on thousands of deals as somebody who evaluated deals for special servicers, somebody who worked for special servicers. Mark has been through multiple corrections, multiple market cycles. He knows how to navigate these times, both for like an investment preservation perspective, and has been a great resource for me and the team on how to look at our properties, our loans, and how to communicate with our lenders and work as a team with them. Mark has friends in the industry who run the asset management divisions of our lenders that we've gone to New York to see and make and have lunch with and just maintain good relationships with, because you want your lender to be your partner in when times are tough. And he's brought a tremendous amount of value in many regards, but in that regard, but also from an opportunity perspective. Mark is also knows how to look at where to go, what resources are, and who to call to make sure we take advantage of those opportunities. So like we're working those angles on a regular and systematized basis because he's set us up for success on both those fronts. I don't know, Mark, if there's anything you want to say.
Right. Thanks.
Thank you.
Listen, what I want to say is that Amy and I have known each other for maybe 15 years. We've worked together with many of those asset managers and distressed debt situations and managing portfolios together as stewards of problem deals. So we collectively have a lot of experience in that area, and I'm thrilled to have Amy here to run the asset management and help us with all of these issues. She's managed massive portfolios, 15,000 units, as the VP of property management for major portfolios that I was involved with, and I have tremendous confidence in her ability to steward the process of pivoting whatever we need to do in whatever direction we need to do with our business plans, so that we accomplish the goals that we've discussed today. And otherwise, I'm gonna shut off and stop sniveling in the microphone.
Thank you, Mark. I'm glad you brought that up about Amy, because she's very modest and will talk about herself. But it's important for our investors to know. There's an anonymous question about K1s for a fund. And I'm not sure if I want to acknowledge the question, but I'm not sure if I can answer that question on this call, because I don't have the answer to you. But if you want to email me at Gideon@GSH Real Estate offline, I'd be happy to follow up with you on that question. I think that we've answered all the questions that are posed, and it's 7:10. I want to, stay. We've got another 5 minutes or so. We're here for you. If anybody else has any questions, please type them in. If not, we'll wrap up. I really, for most of you that know me, you know that I like to talk. So I've had a great time tonight talking, but hopefully I feel I have actually had an even better time communicating what we're talking about and what we're doing every day to you, because you're not here in the GSH offices, you're not involved in our conversations, but you're so important to us as investor partners. You're the reason why we've been able to be so successful, and we value you. We value your trust in us. Quick question on Esker, which is our new development. Is it on target? So we performed and forecasted Esker to take about 2 years to construct. We'll get it done, I think, in 18 months. So we're ahead of schedule there. And we're beginning the pre-leasing on the first phase. So it's 90 units, a building of 45, and then a building of 45. We're wrapping up the first building of 45, which should be delivered in February, March, and we're starting the pre-leasing process here in the next 30 days. So we're excited about that. That's ahead of schedule, and we're starting the construction on the second building of 45. Okay. I really appreciate you all joining us. Thank you, Amy, Alex, and Mark, for joining. Thank you to my investors who I speak to on a semi-regular basis, and those of you who suggested potentially sending out the email that I sent the other day. For those of you who suggested maybe doing a webinar, you know who you are. I appreciate the feedback. I try to listen when I can, and I hear you, I see you all, and I appreciate you. We do. So thank you, and we look forward to continuing a long time relationship with you all and continuing to be profitable. and buy great real estate and help families live in great places. So thank you very much. I hope you have a great rest of the week, and I'm always available. Reach out. Love to talk to you. Have a good night.